Dang it. I'm gonna restart. All right, so Monday, Tuesday, everybody was euphoric. Twitter was euphoric. Bitcoin $73,000 or whatever it hit, right? Everybody euphoric. Dopamine hit. Prices are up, distracting people. Not here at CYPRX. I told you guys calm, cool presentation and understanding market dynamics, inflow and outflow. Back on Tuesday, when I drafted the report to you guys, what were some things that we talked about that now we're witnessing play out in real time that could weigh on risk sentiment? So give me three primary factors on the economic conundrum, right? The whole entire spectrum of factors that could have weighed on risk asset that are now playing out, which we'll get into with our fundamental report from today. I need to change this date. Um,
Yen
somebody,
trade.
somebody give me one.
Yen trade.
Okay, good job, right? The yen carry trade, right? Monday, Tuesday, and previous weeks, investors were aggressively selling the yen, right? Which obviously, of course, lower strength of the yen or depreciation of the yen makes it a lot easier to borrow, considering especially that the Bank of Japan held interest rates, right? And what do investors that are borrowing a cheaper currency tend to do with it? They tend to plug it into assets that appreciate against that depreciating currency to hedge against it, right? And so we saw, I showed you guys in a previous video breakdown, the negative correlation between the Japanese yen basket and the total cryptocurrency market cap. Well, if we go look at the Japanese yen index, you can go here. If you guys don't have it to your charts, you just type in JPY basket. Well, look at this. Over the course of the past couple of trading sessions, the yen has slightly bottomed out, and we've seen capital inflows come back into the yen. Nothing too significant, but still some capital inflows and appreciation of the yen, more so than in recent times, where we've seen outflows. So that's one contributing factor. Whoever said that, because I didn't see the name pop up, pat yourself on the back. You've been paying attention. So that's one factor of currently weighing on risk sentiment. Somebody else give me another one. Think about the US front, think about the data, think about the dollar, think about interest rates and central bank positioning. What's another thing that took place?
Strong labor market.
Okay, right. Strong and resilient labor market data pushing back on those rate cut expectations from the Fed. The Federal Reserve has stated multiple times in previous FOMC releases and meeting in minutes that their primary focus is on inflation and labor market data. And in order for them to continue to cut rates, they need to see continued cooling and weakness in the labor market. Well, over the past like two consecutive labor market reports, that has not been the case. We saw strong ADP figures. Today, we saw resilient unemployment claims with weaker and lower numbers coming out, showing that less people are filing for unemployment. So the US labor market is still showing signs of strength and resiliency, which has dampened the expectation of a future Fed rate cuts, albeit the 25 basis point cut from the Fed is still on the table. But if you look at the CME Fed watch tool, remember in previous trading days when the market was pumping in crypto, and I told you guys this, like these percentages and all these things, it's really simplistic to pay attention to. If you guys remember, when we were back here over the weekend pumping, what was the CME Fed watch tool percentage chance at? Does anybody remember when we saw this? Does anybody remember what the percentage chance was at?
Or it was like 80 something percent.
Yeah, it was like 88 to 90% chance of a 25% basis point cut. Well, just recently, the CME Fed watch tool dropped down to a 70% chance of a Fed rate cut at the next meeting and a 30% chance of an unlikely rate cut. So that the change in sentiment has slightly shifted, where markets with much more money or market participants with much more money than you and I are starting to realize all these aggressive bullish bets, right, that they were taking previous trading sessions. It's now time to take profit as the market's shifting back into safer haven plays like the dollar, bonds, Japanese yen. They're selling their risk assets for safer haven plays as that sentiment is starting to shift, right? So that's number two. Whoever said that and answered that question properly, pat yourself on the back. And then there's one last thing. Obviously, of course, geopolitical tensions are not on the forefront, so I'll alleviate your minds of that. As of right now, there are no new fear, uncertainty, and doubt factors weighing on risk sentiment via the geopolitical spectrum. Yes, that landscape still remains untamed, but right now there was no new breaking headlines this week creating fear, uncertainty, and doubt. So there's one more factor right now that I've talked about in previous reports. Think about it's on the US front and it's about the US dollar and interest rates. But what's one more thing that happened today? If you guys are paying attention, you can kind of see it on my screen up here that weighed on risk sentiment. Can anybody tell me?
Was it the bonds? The bond market?
Beautiful. Heck yeah, AP, you've been paying attention. That's what I'm
Yes,
talking
sir.
about.
Yes, sir.
Heck yeah. All right. So today we had rising bond yields. All right. So remember in previous reports, I mentioned to you guys if you go, so two things that you should be adding to your chart, to your list, just to pay attention to these things is the US 10-year Treasury yield bonds and the Japanese yen basket. All right. So if we look here, this is the US government bonds 10-year yield, and it just reached another significant milestone. Right. So traded at recent highs that we haven't seen since the past couple of days. But when bonds are high, and we'll get into this in the report, it tends to weigh on riskier assets. All right. So let's just read through this report. So you guys all nailed it on the head. I really appreciate you all answering those questions. And it shows me that you guys are starting to pay attention. And over time, you guys are going to start to see how freaking easy this is. You see how we just called as a community a market top, not necessarily saying that it's like a top that's going to like create a complete market crash, but we just called the market top. It's that simple. We were back here on Tuesday talking about not to get too overly excited and not to start buying uncontrollably and wait for discounts and be just calm, cool, and collective until the market scenario unfolds further. And now we're seeing all the things that we were talking about when everybody was euphoric start to play out. And now everybody that was bullish in crypto, buying at these highs, buying in the rallies, buying when freaking Chainlink just hit $12.50, buying when XLR was at 80 cents yesterday, buying when Velo pumped the other day, they're all getting wrecked. They're all getting wrecked right now. They're wondering why they put $1,000 into the market and why it's not worth $1,000 anymore, right? Now would be time to start the dollar cost average in. Now that the market has shedded $47 billion, right? Now I'm not telling you guys to go dollar cost average in because the market could probably go down further depending on how the NFP reports and the unemployment rates come out tomorrow. But I'm just saying, right? You don't want to be buying into euphoria. You want to be buying when the market's shedding value. Okay. So that way you're getting in at discounted prices. So let's just read through this report. Good job, you guys. Really appreciate you all for answering. And it's just really motivating seeing you all starting to pay attention to this stuff because, I mean, we're just going to create an army of solid and found investors. I mean, I'm really excited to see how you guys apply this information over the next couple of years in your trading and your investing regime, and you're going to start to see growth. So, in the last 48 hours, a mix of economic data and geopolitical events have subtly shifted market sentiment from risk on to risk off, leading to a pullback in crypto and some profit taking on the US dollar. We did see some slight profit taking, albeit today, intraday, the dollar is strong. During the Asia session, crypto saw a profit taking now totaling over $40 billion in response to strengthening in the Japanese yen, stronger dollar, decrease in percentage chances of a 25 basis point cut from the Fed, and rising bond yield. So you guys freaking nailed it. All right. Starting with the yen's recent gains following signs of monetary policy adjustments by the Bank of Japan, a change from its prior stance that encouraged capital flow into risk assets via the yen carry trade. So again, remember you guys just talked about that as well. In prior and previous weeks, we had saw capital inflow because the yen carry trade idea was holding weight where investors were borrowing the yen aggressively to buy risk assets. Now we've seen some selling of risk assets to buy back into the yen. Okay. So I told you guys all throughout the week to be paying attention to the rhetoric from the Bank of Japan. Remember, we predicted that the Bank of Japan was going to hold rates steady on like Monday, Tuesday. They did that exactly. So I told you guys that was a high expectation, a high probability of taking place. So what we needed to pay attention to was what? Without reading this report, what did I tell you guys we needed to pay attention to from the Bank of Japan?
The interest rates, if they were going to cut them or keep them the same or raise them.
Good job, AP. Not necessarily what I'm looking for, but still, yes. I was trying to more so aim towards, remember, I told you guys that we had already priced in, and so was the market, that the Bank of Japan was not going to change rates. They were going to keep rates the same and hold rates at the ultra low policy, right? So what we needed to pay attention to was the comments from Bank of Japan speakers, whether they hinted or leaned more hawkish or more dovish, right? So Overnight during the Asia session, the Bank of Japan maintained rates. So usually when they hold rates steady, that tends to keep pressure or sell pressure on the Japanese yen. So we have to ask ourselves, why did the Japanese yen gain strength? Well, it was because of the hawkish comments and the hawkish rhetoric from Bank of Japan Governor Ueda. So Bank of Japan commentary came out hawkish. Governor Ueda mentioned that the Bank of Japan could potentially hike rates towards the end of this year in December if economic conditions align, especially given improved industrial production data that the Japanese front saw. Governor Ueda also signaled that further rate hikes could be on the table at the December meeting, and that's what added to some strength in the yen. So you guys have that in your report. Wednesday's US Q3 GDP showed solid growth at 2.8%. So these are some of the factors that weighed on the sentiment surrounding the 25 basis point cut from the Fed. Close to the market forecast of 2.9%. So there was no significant deviation from the market expectations, which pointed to resilience, but not enough to deter the Fed from continued easing. So we did still see the market pricing in a probability of a 25 basis point cut, albeit at a slower or lesser pace. Then the core PCE year over year stayed at 2.7% today with modest signs of disinflation. Again, nothing too significant, nothing deviating outside of the market expectations. As the overall PCE year over year dropped slightly to 2.1% from 2.3%, aligning with the Fed's gradual inflation reduction target. So we are still seeing signs of disinflation, but nothing too significant. Another factor adding to crypto sell pressure, this is, in my personal opinion, the primary reason, was the rise in US Treasury yields, with the 2-year yields hitting a 3-month high on Thursday following reports of lower wage inflation and robust consumer spending. This data suggests that the Federal Reserve is unlikely to alter its current stance anytime soon, which has been keeping higher rates for a prolonged period of time and not taking an aggressive approach to easing monetary policy, right? Which tends to keep the dollar stronger against major currencies, tends to keep bond yields high, and tends to weigh on risk assets. So, real fast, let's just break down this stuff for you guys because I want you all to understand. So I have here for you guys the CME Fed Watch tool. Here's some screenshots from all the data that I collected. Here's a report talking about the yields gaining on solid data before tomorrow's jobs reports. You guys can see that this is from Reuters. So let's just break this down so you guys understand this and why you should have the US government bond yields as a indicator on your charts or, in your strategy to decide whether or not the market sentiment is risk on, risk off. So to keep it very simplistic, when bond yields, and again, these correlations don't happen 110% of the time. But I'd say about 80 to 90% of the time, you guys can use these inverse correlations to determine risk on, risk off sentiment. That's what I've been doing, and it's been proven extremely accurate, as you guys have seen. So very simplistic, when bond yields rise or are at highs, new highs, or printing new highs, it tends to weigh on risk assets. So let's break that down. When bond yields rise, especially the 10-year Treasury yield, it typically exerts downward pressure on riskier assets like equities and crypto. This impact comes down to the relationship between bond yields, investor behavior, and the cost of capital in financial markets. The cost of capital in financial markets is probably the most extreme highlight there. Here's the report that you guys can click on if you want to read a little bit about where I gathered this information from for the bond yields today. But let's break this down, how bond yields weigh on risk assets and why. So number one, we have to understand when there is a lower appeal for risk assets, we tend to see sell pressure on crypto as larger investors than you and I are taking profit and putting it into safer haven plays. Rising bond yields, like the 10-year Treasury, offer a more attractive low-risk return, diverting capital away from risk assets such as stocks and crypto. For example, if a 10-year Treasury bond yields 4.3% or higher, investors may see it as a more favorable option compared to the risk and volatility of crypto. Cost of capital and valuations. So higher bond yields also increase the cost of borrowing. When yields rise, companies face higher costs to finance growth, which can slow expansion and lead to lower projected profits. In turn, this reduces the appeal of growth-dependent assets like stocks and indirectly affects the broader market sentiment, which can then weigh on crypto. Risk sentiment and liquidity flow. Rising bond yields reflect a shift towards a risk-off sentiment. So that sentence right there, if you don't read anything else from this report, just understand that. Rising bond yields tend to weigh on risk sentiment. So it creates a risk-off market mood intraday. I'm not sitting here saying that we're going to see a complete market sell-off down to $1.5 trillion, but intraday, this is why we're seeing some profit taking and a shift in capital back into yield, right? Or bond yields. So especially when yields rise quickly or unexpectedly, like they did today, this can prompt investors to reduce exposure to riskier assets via from more volatile assets like crypto in favor of safer bonds. Relationship to inflation and growth expectations. Treasury yields can rise due to expectations of stronger economic growth, which we've seen, which often are associated with higher inflation or steady inflation. Inflation concerns can weigh on asset prices because they may signal higher rates for a prolonged period of time from the Federal Reserve, as you all have seen this week. Excuse me, which reduces liquidity in markets and makes it harder for speculative assets like crypto to perform well. Rates of change. It's not just the absolute level of the 10-year yield that impacts risk assets, but also the speed of increase. Rapid rises signal a significant shift in market expectations, which can shock equity in crypto markets like we saw today. We saw just a random drop of over $40 billion in crypto today, albeit over the past, let's just say 24 hours, the market in crypto was consolidating, right? So you can see here, the market was consolidating. That's because bond yields were relatively steady. And then today they randomly just increased in value because of the shift in expectations and data. And that percentage decrease in the probability of a 25 basis point cut from the Fed, which increases bond yields, keeps the dollar stronger for a prolonged period of time as market participants start pricing in a higher for longer interest rate environment. And that sucks liquidity out of crypto. All right. So that's why we just saw these random two bearish candlesticks, boom, back to back. Right. So you guys will have all of this in your report. So after reading this report, I'll drop this in the chat for you guys. Just study it a little bit, go through, take your own personal notes. You now understand why this stuff is so important and why today we saw crypto pull back over $50 billion, right? Right now, down about $51.3 billion on the day, or 2%. Okay. You're going to see people on Twitter and on the internet absolutely confused, getting wrecked, that bought at tops 2 days ago on Tuesday when they thought that the market was going to go to brand new all-time highs because Bitcoin was trading at $73,000 and all the fundamentals were saying $100,000 Bitcoin is going to happen by the end of October, right? No, it's not how these markets work. Sorry to, burst anybody's bubble, but we're going to continue to pay attention to this stuff moving forward. Tomorrow, what would be most ideal to see risk asset sentiment and this just turn into a pullback instead of a further decline in price, and for us to see some stalling out of sellers and buyers come back in, is if we see